Hey, Jeremy Searier here from Mansard. 2022 market update. I'm going to take you through some new data. We're going to look at the latest sales trends as well as what's happening in the markets. But look, the big question right now is what's the impact of interest rates going to be? How high are they going to go, and how long is this going to go for? We're going to look at what's happening in the market and how the data is showing us what is occurring. So let's take a look at some information and get started. By the way, if you like these videos, hit the subscribe button so we can keep you up to date on what's going on. Let's go. All right, so welcome to our How's the Market update here at Mansard. One of the things that we know here at the company is that finding the right commercial real estate buyer who performs on a deal can be really hard to do. And bad deals made with wrong buyers, they lead to failed sales. It's embarrassing, and you can end up with a discounted sale price, which is a terrible thing. So we developed a 42-point process to connect commercial real estate owners with high-performing buyers who pay the right price so that they experience financially meaningful life events with their investments in real estate. So when you sell to the right buyer, you experience a financially meaningful life event with your real estate investment, and that's what this is all about. That's why we develop and share these market insights in this data, because if you don't understand what's happening in the market in real time, it's going to be really hard to make the right real estate decision. So we've taken data from Middlesex, Essex, and Rockingham Counties. These are representative of the Boston suburbs, and we track the sale of retail, office, and industrial properties from 1 to 100 million on an annual basis. And the reason why we do this is because we want to understand how making the right real estate decision fits into the overall timing of the market. So here we are. This is the year-by-year picture of sales volume by number of buildings traded. And what you'll see here is that last year was a crazy bump. It was a year when we saw 839 sales happen. How big a year was that? The long-term average from 2006 to 2021 has been 439 sales a year. So this is almost double the long-term average in sales. 2022 has actually been a really strong year. We've had over 600 sales happen year to date. And if we annualize that out to the rest of the year, we're going to see a year-end number somewhere around 700 sales. Our projection is about 689 sales this year. So still really strong this year despite the war in Ukraine, despite the Fed raising rates. We are still seeing a lot of activity in the market. Concerns, though, however, really fall into looking at year-over-year change in velocity and seeing how active buyers and sellers are in the market. When we do see a peak year like a 2021, it's often followed by a slowdown the following year. So what we see here is a similar trending by velocity. We haven't seen that sort of deep cutting slowdown in the market that we saw in 2006 and 7 going into 8, 9, and 10, where we saw the market just slowed down because the debt, it just locked up. No one knew where value was, and it was very difficult to form agreements in that market. The market we're in now, the challenge is figuring out how to underwrite in a rising rate environment, and then how to understand what your exit valuation is going to be when you don't quite know what a new underwriting standard is going, a reliable underwriting standard is going to be from the debt market perspective, because the Fed is still in a raise rate pattern. Okay, so we are seeing a slowdown occurring, but it's not nearly as dramatic as it was back in 2007 and 2008. Looking back at the 10-year Treasury, this is the average yield by year. And what's interesting is when we look at this, you can see that we've been in a downward trend since 1990. in the 10-year Treasury, where we've seen some bumps, but overall we've been in a downward trend. The 10-year Treasury bottomed out in 2020, and we're now in a bounce. And the bounce is being driven by the Fed raising rates. And we're seeing this affect cap rates in the market and overall discount rates for what expect these investments to pay. Looking at the overall market trend-wise, we're still in a very active year, but we are beginning to see signs of slowdown. So let's look at this over a 24-month period. I created this slide because I wanted to see what's happened with the Fed rate hikes going back to January 2021 all the way up to November of 2022. This is a month-by-month shot of those $1 million to $100 million sales, and I plotted the Fed rate hikes here in 2022. Not really a major deterrent in sales here, in the sense that we saw the end of 2021, December was a huge month. There were 118 sales. Going into January and February, everyone took a breather, and then Russia invaded Ukraine. Things they picked up in March, April, May. We had closings that were really rollovers from the end of 21 and formed in still that same rate environment in January and February. Those deals started closing out as the Fed started raising rates, and we started to see upward pressure on commodities and fuel in the market. So the market, typically we're lagging 6 months, a year on these types of trends. And I think the data is showing this, because when we get out to June, July, August, we're still seeing very healthy volume in the market, even as rates are ticking up very aggressively and very quickly. Even September was a very active month for sales transactions. October, however, if we look at October of 22 compared to October of 21, this may end up being the first month where we start to see some deceleration in the market in 2022. And we're not going to know this for sure until we get out to the end of November and December. But I'm anticipating that the Fed continuing to be raising rates as quickly as they are, it will start to show up in these monthly numbers, and I expect to see more deceleration happening. Deals are going to continue to trade, but we're going to see fewer buyers in the market because the underwriting in the market is becoming a little more tricky. So if you're not pricing knowing these things when you're going to sell in the market, you may just completely miss the connections and conversations that are happening in the market today that are still resulting in transactions. And if we look at the market overall, we've had a lot of appreciation in the market. The retail market here at the top, you can see with the average pricing per square foot, we are now starting to see a downward inflection in pricing, which is reflective of prices coming down in that market segment. Interestingly, the volume's still very high. Flex market, this data bundles in the life science, lab and life science segment in Flex. Those sales this year have really bloated out the Flex market. So to truly understand what's happening in a Flex, we actually need to break lab and life science out from Flex completely to see it as a standalone, because it's just not consistent with the overall Flex market. The industrial market's still appreciating and climbing, and the office market starting to flatten out, and anticipating potentially some devaluation there. Pulling out and looking at the national market, just to contrast our Boston area, this sheet or the snapshot comes from Green Street. They put this property price index out. They update this maybe every 60 days or so. What they're reporting now is that nationally the market has already started to correct. It's rolled over, and we're seeing a 13% correct in values.
This is just driven by interest rates. It's just straight up finance figuring out what the rate impact on valuation is. But this 13%, this isn't a number that you can go across every asset class and say everything's down 13%, because that's not necessarily the case. This is an overall average for the entire country, drawing on multiple data sets. I would classify this more as a fully stabilized asset at market rent is being revalued by 13% due to lending rates. Okay, so the other interesting thing is the composite index from CREPI. This is a market sentiment index, and you can see here that going back to 2000, market sentiment is pretty bad. People aren't feeling very optimistic about the market we're heading into. So this essentially says there's a lot of headwind in the market right now, and this is being driven primarily by bad news, recession fears, rate hikes, uncertainty and unrest in Ukraine. And then we just had the midterm elections and uncertainty about the political climate and where things are going. So let's go back in and look at our county levels, and let's start with retail. The thing here that's interesting is the numbers actually say that 2022 is going to have more volume than 21 for retail sales. And if we annualize that out, this will be a very high volume year for retail. However, the average price per square foot is coming down. So how do we explain this? What we're seeing in the data is that more assets are trading. They're coming into the market, but they're being repriced. And buyers still want these assets. They want to own retail. They see retail as a strong category to be in the greater Boston market. But we're seeing pricing that's reflecting a number of opportunities in the market and the rising rates that we're seeing. Dr. Glenn Mueller puts out a market cycle monitor, which is a report that comes out quarterly. We subscribe to this, and what I like to include here is his forecast. So this is taking his data and forecasting it out into the second quarter of 2023. He's putting the retail market in the Boston area at the peak phase of the market, which is late expansion. I think the pricing we're seeing in the market is actually starting to point to more of a hyper supply trend in the market, but we're seeing velocity still very high in retail. So not all bad news for retail. The industrial, this has really been the headline asset class for all of us in the real estate market. It's been very active, very tight, and we have seen a lot of new construction starting to come into the market really over that 100,000 square foot mark, where it makes sense to build new supply in the market. If you're under 100,000 square feet, we're still seeing user demand that's highly active in that 15 to 50 to 60,000 square foot range. They are having a difficult time finding space in the market. These buildings are continuing to trade very aggressively. 2022, a very active year to date, and we're looking at a year that may end up having a similar number of buildings traded as 2020. It will not be as busy as 2021, but we still see industrial holding up as a very strong asset class with great pricing. You can see here the average price per square foot in the three counties we pull the data from is in that 187 to 188 a foot range across all industrial. So a very strong asset class. We are starting to see some rents leveling off and some pricing leveling off, and that's really being driven primarily by the interest rates in the market. Dr. Glenn Mueller here, looking out into the second quarter of 23, he's saying Boston is at that that peak phase, late expansion, where we're going to continue to see high demand for the asset class on the user side and the investment side. So how about office? Ask me what's going on with office. In office, it's a challenging asset class. It's become more and more difficult to underwrite given the rapidly changing and reconfiguring of demand in the tenant market for how companies are using office space. Pricing wise, we're seeing pricing bounced in 2020, and we saw this 2021 pricing that was actually pretty good, over $200 a square foot, but that seems to be showing signs of leveling in our market. And I think that we've got some risks in the market. There's some deceleration happening. 2022 looks like it's going to be more of like a 2018 or 2016 year by number of trades for office buildings in the market. So we may actually start to see some continued softening in the office market as the sort of tenant demand story unfolds, where we see leases starting to roll over and determining whether we're going to see continued occupancy or continued leasing of space as companies try to sort out hybrid versus full-time in the office. So the other piece of this is Dr. Glenn Mueller. He's taken a look at the office market in Boston. In my quarter 2 video, he had Boston in the early expansion phase, so it was up around that 6 or 7 point. It's regressed down to 5, which is a late recovery. And in this stage, we're typically seeing very little rent growth. Rents tend to be flat. They might be a little negative. We're seeing vacancy is becoming stubborn for landlords, and it's becoming a little bit of a challenge. So I don't think the office story really starts to get interesting until we see tenants returning to the office and starting to bump up demand for space in the Boston area and moving us back up into an expansion trend. So if you like this video, please do subscribe to it. We are constantly updating this market data and posting it. Want to keep you in the loop on what's going on. And if you are interested in learning more about us, you can visit our website at www.mansardcre.com. We're here to help, and if you have any questions, feel free to reach out. And I look forward to seeing you in our next market update. Thank you.